thanks for tuning in to Market Lab. I'm Ryan, and today we're going to be talking about what a company's market cap is, how to calculate it, what it implies, and why it matters. So let's get into it. Simply put, a company's market cap or capitalization is a total value of its common equity. Now this is distinct from the total value of the firm, which would include things like debt, preferred shares, and minority interest, less any cash. Calculating market cap is pretty straightforward. You just need the company's latest share price and the current number of shares outstanding. You can get the share count from the company's latest quarter, or more realistically just from Yahoo Finance, and the share price from pretty much anywhere nowadays. Putting these numbers together for Amazon gives us a market cap of an incredible $1.86 trillion as of the making of this video. As a result of strong market rallies in 2020 and 2021, there are now 5 companies in the world with a market cap in the 4 comma club. The largest companies in the world, well, they're still pretty much all American. In fact, of the top 25 largest companies, only 7 aren't. And, as you can see here, the largest companies are really clustered in the tech and consumer discretionary spaces. So what does it imply? Well, simply put, the share price is the share price. It tells you what the market is willing to pay for those shares, and by virtue, what it thinks the total value of the company's equity is worth. But it's not a valuation technique like a discounted cash flow or relative valuation, but it can be useful as a helpful sense check on the reasonableness of a company's valuation. For example, as of the making of this video, Tesla has a market cap of around $615 billion, which isn't too far off the size of its 7 largest competitors combined. Now, we're not here to tell anyone what's overvalued or undervalued, but knowing how big a company is adds useful context when factoring in return potential or comparing things like sales. Another way that market cap is relevant is in categorizing companies by their size. A stock is considered small cap if it's under $2 billion, mid cap if it's between $2 billion and $10 billion, and large cap if it's over $10 billion. This has the impact on the type of investors that can own a stock. For example, a blue chip mutual fund will typically have it written in their fund mandate that they can only invest in large cap stocks. The thinking goes that, generally speaking, larger companies are more safe because they tend to be diversified across products, markets, regions, and have established histories and customer bases. Smaller companies are typically viewed as more risky or volatile, but offering greater potential for return. A good example of this is the electric vehicle market. While large cap stock Tesla is considered very volatile for its size, compared to its small cap peers, it doesn't really seem that volatile at all. So, that's market cap. Thanks for tuning in.